Welcome, everybody. My name is Jeff Green. I'm the president of Green Team Realty. Thanks for joining us for the November 2020 housing market update. In the housing market update, we learn about everything relating to the housing market, everything that's happening. And there's a lot of things happening in our world right now, economically, politically, so on and so forth. So let's dive right in and check out our slide deck, and then we'll join with the panel in just a minute. So, what did people do with their money that they got from the stimulus checks? Well, it's an interesting question that we have the answer to. Believe it or not, a lot of people paid down debt, which is not the worst thing. They saved money, and 30% of the money was spent. So not a bad ratio there. You would think us Americans who love to buy things, it would have been a much higher percentage in the spending column. But primarily the money, you can tell that people didn't wildly spend. They were probably somewhat apprehensive of parting ways with that money, hence the reason why they cleaned up their balance sheets by paying down debt and saving money. So just an interesting factoid for you there. U.S. consumer spending since January 1st of 2020 is only down by 3 and almost call it 4%, 3.7%. When you take a look at each state, you can see that most are in the -10 to 0% column, but there are quite a few in the blue, which are ahead of where they were in January 1st. Now, if you can think back, if you can think that long, it's been probably seems like almost a decade this 1 year has taken, because it's been such a crazy one. But the economy was absolutely zooming. Things were full speed ahead. In the January housing market update, there was no signs of slowing down as far as the housing market went. Everything was moving. It was going to take a major global event to slow the economy down, and that's just what happened. But needless to say, as we're now six plus months out of it, we're only down on the consumer spending side by 4%. An update on the weekly unemployment filings. This is in millions of filings. You can see that it's come way down. This is when the first program, stimulus program, was put out, and people were, getting additional money for being unemployed. So you saw the numbers just fly. But they've steadily come down, and they've been staying down and trending down still. But of course, it's still at a high number that we don't want to see our economy, our nation, be at too much longer. And this is just a look at, how many people are currently receiving unemployment insurance. Again, the numbers are trending down, heading in the right direction, which is where we want it to be. Mortgage forbearance. If you could remember, there was a program put out by the federal government where basically anybody could go into forbearance on their mortgage and not be all that negatively impacted by it. At first, there was a big rush to that, but many people have come out of it, and you can see here that it's a much smaller number of households that are actually in forbearance right now. What's interesting is that of the total people, right, of the 5.7 million families that were granted forbearance, here's basically what's happened upon the expiration of the plan, right? So the forbearance was for a certain amount of time. And then when that forbearance was up, they had to make a decision as to what they wanted to do. What's interesting is that some people have extended it, okay, roughly half, call it. But then there's, the other half, the other 55% or so has done some other things. 44% basically came out of the program while they were performing, meaning paying on time. And 500,000 people actually paid off the mortgage. Now, does that mean people pulled money from their savings account to pay down the mortgage? Probably not. It was probably more of a sale of the home took place, and that's why the mortgage got paid off. But 44% of the people that went in came right out with no, negative impact whatsoever. And then you can see here the small percentage of people that are actually in a delinquent situation, or, now in a loss mitigation with the bank, trying to do a workout essentially. So, not so bad news here. And clearly, I don't think it's any sort of sign that we have a massive foreclosure wave coming at us. In fact, Ivy Zellman from Zellman Associates said the likelihood of us having a foreclosure crisis again is about 0%. Now, I would qualify that, because that's a forever type of statement, right? I would say within the next couple of years, the foreclosure crisis may be 0%. I don't think it's wise and I don't think Ivy meant for it to be forever, but in the short term, I would say. Months of inventory, homes for sale. Now, we spent a lot of time talking about the lack of inventory at last month's housing market update. And yet again, here we are talking about basically the same thing. And you can see the months of inventory is at its lowest level in a year. All right, this goes back 12 months. And you can see that, there was a large uptick in April and May, but that's largely because a lot of state governments shut down the ability for realtors to do deals, and there just weren't closings happening, and it was still spring and people were putting their houses on the market. But you can see it's just fallen way down, and it's a problem. We're going to hear from some troops on the ground, realtors who are actually doing this day in and day out, and I'm sure we're going to hear them echo that sentiment. So why is it that we have such low inventory? Well, there are, fewer homes on the market now than there were this time last year. So that means that just this natural amount of listings that comes on the market is just not happening. And you can see that, people, this is, from a Zillow research report, financial uncertainty is a problem for people. Life is just too uncertain right now. They just don't know which way the wind is blowing, right? I mean, it's been crazy. An election year with the president at the top of the ticket, COVID-19 health concerns, the stock market plummeting and racing back and hitting an all high level. It's just, things are all over the place. So there's a lot of apprehension and anxiety right now, but we're going to hear from our realtors in a little bit that, if you're somebody who's on the fence about selling, you really shouldn't have that nervousness about you, and we'll explain that in a little bit. Projections on home price appreciation. I mean, you take a look at all these different, organizations that are followed by us and others and are reputable. The only one that's way out of line here is CoreLogic, which is a very reputable company and one that we watch. Not so sure why there's such an outlier on price appreciation, but needless to say, pretty much everyone is very bullish on what's going to happen with pricing as we go into the next 12 months or so. And, we'll hear from our panelists to say whether or not they agree with that. Mortgage rates. Here's just, from the MBA here, Mortgage Bankers Association, this is kind of their projection on what's going to happen, what they're viewing interest rates, 30-year fixed, is going to look like over the next, 3 or so years. So it looks like they're, calling on a steady increase. We have financial consultant Ken Ford here today is going to talk a little bit about the bond market. Housing affordability index. Now, this is an interesting thing, right? Because the higher the number, the more affordable. That's how you read this graph. Despite the fact that prices are what they are, affordability remains good, right? Affordability is in a good place, largely because interest rates are so low. And again, we're going to talk a little bit about that with Ken, and that's really kind of the lead indicator as we move forward, is can rates stay low enough to keep this thing going? So here's just some other things that I thought would be good for everybody to know. What's going on in commercial real estate? Well, to bring it to you fast, right? Because we only have 30 minutes here once a month, and I just need to get things across to everybody fast. This was the best set of numbers that I could give you for what's going on in commercial real estate. 157 million square feet of office space is available to sublease. An interesting thing that's happening is that landlords are not necessarily seeing their tenants going into arrears on their rent. They're not stopping the rent payments. What they're doing is they're trying to sublet it. They're shrinking the size, the footprint of their own business office space, and they're leasing it out to others. So there's a big market now for sublettable office space. And in the shopping center industry, it's not good. A Phoenix Metro Center Mall had been open for 47 years before it just closed this summer. So that's a sign of the times, right? I mean, retail was already under a lot of pressure, and then you add this pandemic on top with the people afraid to go into stores and this, that, the other thing. It's really been a rough patch for retailers for sure. And then hotels. Hotels probably have gotten hit the hardest. This is the percentage. So almost 20% of hotels are now delinquent on their mortgages. That's a big deal. That is something that is big enough that could be some sort of contagion into the financial markets and ultimately spill into other markets, such as the housing market. So that's something to watch. Interestingly enough, some of the investment companies are, I've been reading that the investment companies are almost being loan sharks to these hotels. They're putting high interest loans out to these hotels to help keep them afloat and keep their operations intact. And I think that that's a good sign because they believe that the travel industry is going to come back as a whole. And I do think that as well. I mean, I don't know about you, but man, I can't wait to go on my next vacation. I am just so ready for it. I know probably everybody in America is too. So I think that cruise lines and hotels are going to come back in a big way. Here's an interesting chart here. Information ultimately derived by the Case-Shiller U.S. National Home Price Index, but this just shows you home pricing on a 18-year basis, right? Going all the way back to 2002. You can see these gray bars are the recession periods of the economy during that time, what was happening. But you can just see the sheer, valuation of the U.S. Can't ignore is the next American housing crisis, which is looming, and that is evictions. Check this out. Federal and state moratoriums have largely shielded U.S. renters, right, from being evicted. And it's in its 8th month, and there's more than $7 billion in rent expected to accrue by the end of 2020, meaning landlords are holding the bag on $7 billion in rent. That is not a good number. And a lot of people, a lot of landlords are chomping at the bit to evict and to get paying tenants into their units. The interesting thing is that the rental market is still very hot, at least in our territory. Very hard to find for people to find places to go. One thing I wanted to follow up on that I mentioned last month, and Ken, thanks for helping me with this. We mentioned Blackstone. Back in 2012, Blackstone formed this subsidy of itself, Invitation Homes, which ended up bringing public in 2017. And Blackstone sold its position in Invitation in 2019 and cleared $7 billion. Just very smart. And, this article that we found in Housing Wire that Ken found and shared with me, it was funny. One of the guys who was quintessential in forming Invitation said it really just started out on a piece of paper at a conference table saying, how can we capitalize on this down market in residential homes? So at their peak, they bought over 30,000 homes. They spent about $10 billion, and they spent another $2 billion fixing them up. And at its peak, they were spending $100 million a week scooping up properties, often in the Sun Belt. So that's just some interesting information that I promised I would follow up on. Now let's take a look at some raw numbers here. We bring these charts to you every month just to kind of keep you apprised of what's going on. These are national numbers here. You're looking at U.S. existing home sales. Again, pandemic hit March, April, May. Things were, not really knowing where things were going. A lot of states were shut down. States reopened. Boom. Just shot right back up, and it's stayed steady above year over year. So no reason to believe that this chart is going to trend down before the new year. It'll be very interesting to see where we start out in January. That's something that I'm interested to see, where we start. Home sale price, just almost like a rocket ship here, still just what a variance here between last year and current year. So prices are rising for sure. Months of supply. Again, here we are, right? This is the big story. It's continuing to go down and down and down. Just there's no inventory, a problem that has yet to be solved and probably won't be solved. The solution is probably going to be rising interest rates, which brings buyers out of the marketplace, and then inventory levels get back in check. That's probably what's going to happen. Orange County, a little bit more of a local look. Look at this shot here. This is just a rocket ship, right? Wow, how this took off. Just what's going on down in New York City and the exodus of people. Orange County has definitely benefited from it, as has Sussex County. You take a look at average sale price, similar trend, a big variance from last year. There's been a big price increase. But interestingly enough, that price increase was happening even before the pandemic hit. You can see the large variances in January and February. Sussex County, similar thing. April, is just a rocket ship since then. It's just trending up. And I mean, for October to have closed higher than any other month in the year is kind of a big deal. But it just basically what happened was that the spring market got pushed off because of the shutdown. And again, average price, very similar charts to everything else that you saw. All right, so some housekeeping items, then we're going to get to our panel. I'm anxious to hear from them. Our next housing market update is going to be Tuesday, December 15th. That'll be the last one for 2020. You can always check in and stay in touch with us at greenteamrealty.com/HMU. And once again, a thanks to our friends at Really, the Business Referral Exchange, for sponsoring the housing market update. You can check them out and sign up at reallyhq.com. Okay, that was a mouthful. So let's bring our panel into the mix here. I'm just going to kind of call your name. You can just wave real quick, and then we'll get right into it. Keren Gonen from Green Team New Jersey Realty, Laura Moritz, Classic Mortgage, Barbara Tesa, Green Team New Jersey Realty as well, Ken Ford, Warwick Valley Financial Advisors, Carol Buchanan, Green Team New York Realty, and that's our panel. So, Keren, we'll start with you down in Jersey. A lot of information that we just shared there, some dynamic information relating to evictions and commercial. Just any sort of snap reaction from you as to how you're feeling things are going?
I think we definitely still have a shortage in inventory, and the buyers are still coming out of the woodworks. So I'm sure the rest of my colleagues on the ground, as you call us, will confirm the same. We are working just as hard as we were in springtime. There was, for me, a little bit of a lull right before the election and right after the election. I'm assuming because of political issues of some sort, but I could tell you this week we're right back at it.
Yeah, interesting. And Carol, your mic is muted, but why don't you open that up? And I want to ask you this. This issue, that report that we saw that Zillow put out there about why people are apprehensive about putting their homes on the market. What do you have to say about that? Should people have all these fears, or, where should their heads be if they're thinking about selling?
Well, I think there is a lot of uncertainty. And I think people are pulling back a little bit. They want to see what's going to happen with this COVID and just generally what's going on. So they're just holding back a little bit to see how everything shakes out. But I think come January, February, they are going to start putting their homes on the market for sale. And I think that next year is just going to be as crazy busy as it was this year. I don't see that slowing down at all.
Well, I've been asking you that question. What's your prediction on what the next year holds now, Carol, for a couple of years? And you've been right every time. So I think everybody should listen to what Carol says. Now, Barbara, to play off of what Carol just said, should sellers be apprehensive? In my opinion, there's almost never been a better time to sell, ever. In as far as, I'm relatively young age-wise, but I've been around this industry my whole life by way of my parents being in it, so on and so forth. And I can just tell you that this is a unique market right now. Do you agree with that?
Yeah. It absolutely is unique. I think still, though, those that aren't putting their house on the market right now still has a little bit to do, if not a lot, with the uncertainty of COVID, whether or not they'll have a job, so that if they sell, they have some finances to lean back on and get a mortgage, which they can't if they don't have that income from a job. And some of them are still hesitant about letting people in their homes if it is listed for sale. So there's that difficulty still of getting your house sold to a certain degree. But it's definitely a good time to do it. I'm telling all of my sellers, yeah, let's get it on the move. The rates are low, so buyers are still out there and willing to bid even above list price, which I'm not a big fan of. But the market's great. It's good for buyers. It's good for sellers. Buyers because the rate's low. Sellers because the prices are higher. Right. But some of those sellers that are older have to have a place to go. And if they've lost a job or have interim income that isn't so great, they can't get the mortgage that they might need to move. So it's still a little bit of an issue. mortgage
Okay.
wise.
And then one question to all three of you ladies who are realtors on this panel. Would you not agree with this statement? Every year, there's always a debate, right? Should I put my house on the market now? The holidays are just ahead. Maybe I should hold off until after New Year's. I would say to anybody who has the ability to put their house on the market, put it on now. There's no reason to wait. Forget about Thanksgiving and Christmas. That is irrelevant this year. Would you guys agree with that?
Absolutely.
Yeah.
Yeah.
No question.
Okay. That's how intense this inventory situation is. There's literally so little inventory that buyers are just having to look regardless of what's going on inside of their lives, regardless of what's happening.
Yeah.
All right. So Ken and Laura, let's bring you guys into the fold. We're already at 22 minutes after. We've got about 8-10 minutes left here. Ken, we were talking earlier, and Laura, that a lot of this, whether this thing keeps going or not, is going to depend on, quantitative easing, unfortunately, and also what's going on with the bond markets and whether that ultimately translates to low mortgage rates and so on and so forth. So, Ken, we'll start with you. I know that you've prepared a lot of information and done a lot of research, so I'll stop talking, you start talking, and we'll go from there.
Well, thanks for inviting me. I was here in March, and if you told me that we're sitting here today and I'm looking at the asset prices, whether or not it's real estate, the S&P 500, the Dow Jones, or any of these, I'd be pretty shocked. I wouldn't believe it. It all comes down to, if you look back and see what happened, the government and the Federal Reserve came to the rescue with trillions and trillions of dollars and forcing interest rates down. And most people don't realize this, but when you bring interest rates down, you bring asset prices up. So, it's not a $10,000 question anymore. It's $1 trillion question, is can they continue to keep interest rates down? And, low mortgage rates obviously inflate housing prices. And that's what you're seeing with the Case-Shiller price index, as well as stocks and bonds as well. Now, what I'm hearing is we have a lot ahead of us, a lot of problems ahead of us that the Federal Reserve is going to have to tackle. I don't want to get into all the problems, but I'm hearing that they're going to try to push interest rates negative. That's what their plan is, and they've talked about it a lot. So obviously,
when you say interest rates, just so that we're clear for everybody, you're not talking about interest rates for a home mortgage. You're talking about interest rates for what?
Bank accounts, treasury bonds. So if you go out there and invest in a treasury bond, which is the safest investment on the planet, you're getting about 1% today, depending on the maturity that you buy. There's a lot of talk right now between the Fed, Wall Street, portfolio managers. They're thinking they have to go negative on those interest rates, meaning when you leave money in the bank, they're actually going to take money away from you. You're not getting any interest right now,
right. Maybe
1% if you're lucky. But they're talking about bringing it negative with the problems that we have to face. And the problems we're going to face is insolvency of corporations. The Fed went out and bought junk bonds. The Federal Reserve can never, by mandate, buy anything besides treasury bonds. And in March, they started buying junk bonds, which are corporations of very low credit, just to keep them in business. So when I look at your markets, I don't see any changes. If they're going to shoot every bullet they possibly have at this thing to get us out of a recession or mini depression or whatever you want to call it, they're not done. They printed $4 trillion since March. The government issued out $4 trillion worth of stimulus. And I'm hearing they're going to double and triple that over the next year or two. So I think for the short term, real estate, especially in Warwick, is going to do great. I can't see them letting interest rate rise, and they're going to do everything in their power to keep them here. Now, what do I think changes that? Well, when you print money, it's inflationary. It's inflationary to assets. When the price of houses go up and you don't change, you didn't do any renovation, you didn't add decks, you didn't add pools or hot tubs, well, the house is inflated from where it was, right? If someone wants to buy a house today, it's inflated from where it was 6 months ago, maybe a year ago. Stocks and bonds are inflated. I see inflation in assets. If it leaks into, call it ShopRite, right? We're going to have a problem. And that's the end game, is when all of this money printing starts to go into the things that we need, the services that we need, and the goods and services food. We see it in healthcare. We see it in college education, which maybe this fixes college education, because if I had kids in college right now, Jeff, I don't think I would be paying the tuition. So at least my kids are in the middle school here and I'm not paying the tuition. But yeah, getting back to everything, it's the interest rates and tacking on all this debt probably is going to have a negative effect. And we just don't know when that's going to come, as in, you probably have a good market for the next year or two, because I don't see the Federal Reserve, and they've said they're not going to move for at least 2 years, and they're going to let the economy run hot, and they don't really care about inflation running hot either. So that's my answer to that.
What's your wisdom, your wizard wisdom on the timing of when things might change on the rates? Are we talking 6 months, 9 months, or you think it will be all of 2021, that we're still below 4% or 5%?
Well, the chairman of the Federal Reserve said at least to 2022 that he will not. So let's step back. The Federal Reserve raises the short-term rates in this country, which affect bank accounts first off, but then they trickle into something called a 10-year Treasury bond, which that's what most mortgages are based off of. So they're not going to touch short-term rates. They said for like 2 years, and some people are saying they can never touch them again. When they try to raise interest rates, I think it was 2018, the stock market fell apart. And they stopped doing it, and they reversed themselves and started printing money again and lowered interest rates again. So we haven't seen them try to raise interest rates since the Great Recession of 2008. And when they tried it, everything fell apart. So I don't expect them to try it anytime soon.
So then really the thing is, okay, so if the Fed's, tweaks to the rates are going to basically be static, what other factors could affect the 10-year Treasury bond, which could then affect mortgage rates?
Well, the 10-year Treasury bond is mostly affected by market participants. And if market participants, meaning hedge funds, endowment funds, institutions, large holders of securities like Vanguard and Fidelity, get spooked and they start seeing inflation data, inflation is bad for bonds because you're a fixed rate of return. And inflation goes from what they think is 1 or 2%, which I think is higher. I just don't believe their statistic and how they measure it. But we've seen throughout the 70s, we went from 2% inflation to 15% inflation because of policies that we are doing today. Now, if inflation starts to rear its ugly head and market participants start to move themselves out of bonds into something more inflationary, more inflation protection securities, well, interest rates are going to rise on their own and the Fed's going to have to buy more and more and more. And what stops them from doing that and what gets that printing press taken away from them is high inflation levels from consumer goods. That's what stops all of this, but I can't see that in the next year or two. I do see it in ShopRite. I have a client that works for ShopRite, and we just started going through prices of stuff. And I don't know if you've noticed it, but they're up more than 2%. They're up like 10, 20, 30%. She said her hairspray went from $1.19 to $1.60. Hairspray, little items like that are starting to rise a lot. This whole COVID thing, breaking supply chains through China, all of the stuff from China is going to cost more coming over here. So I think we're going to feel it. We're just not going to see it in the data. Most of Wall Street pays attention to the data, not what they're seeing with their eyes on Main Street. But I can't see how this doesn't end in an inflationary environment, which is going to be good for real estate, except the rates, right? Inflation is normally good for rental properties. You can raise rents. So I could really see that, a good investment being rental units because you can raise the rent and keep up with inflation if you have to. It's obviously going to affect some higher end properties that you have to use mortgages and large mortgages. So if we go, Laura could probably attest to this, but if we went back to a 5% mortgage, what damage would that do on housing prices? I'd have to say it'd probably knock them down 10, maybe 20% if I had to take a guess.
Well, so Laura, let's transition over to you. I mean, you've sat here and heard a lot. What are your thoughts?
I have to agree with Ken, and with the interest rates being so incredibly low, I mean, you could buy so much more of a house, and it's all about selling a monthly payment. People aren't really buying the house price, they're buying the payment of the house. So with the interest rate so incredibly low, the market is it's absolutely crazy. So I agree with everything that Ken said. And
what's the
I'm seeing people who have literally millions of dollars, and they're taking out 95% financing on their houses because it makes sense. You know,
Laura, what's the rates today? If you want to give an overview of where rates are on like a 15 or a 30 year.
Okay, it depends if you're refinancing or purchasing and what state, because the rates do fluctuate from state to state because of the tax on the mortgage. But let's say right now in New York, with 20% down and a clean credit score of over 700, you're getting about 2.875 or 2 7/8 with no points. 15-year fixed, I'm locking people at 2 3/8, 2.375, something in that range for a rate and term refinance. I mean, the interest rates are ridiculously low.
Yep.
For refinancing, I mean, it's still a great time to refi. I kind of thought I went through everybody and, that everybody already did it, but there's still a lot of people. I'm getting at least 2 or 3 a day who are still paying 5 to 6%. Jeff, you're raising your hand.
Yeah, I haven't refied. I had a good rate years ago, and we refied to a 15-year, and I'm on the back end of the amortization schedule, and who knows, we may end up moving in a couple years or so. So I don't know. I'm a complicated subject, so
Laura,
not worth getting into. Not worth.
When you're looking at a payment for, let's use a $400,000 mortgage, and rates dropped, I think we were up almost 4%, right? About a year and a half ago. Now you're down in, let's call it 2.5. Would you say that a mortgage payment on a $400,000 house is now the same on a $500,000 house? Do you think it's about $100,000 more that you could purchase a house for the same payment, right?
That's correct. And again, people are not buying the house price; they're buying the payment associated with the price with the taxes. So yes, people are buying a lot more expensive homes because the rates are so incredibly low.
Yeah, and for somebody who's sitting here listening to this, and if you are a potential seller and you already have a place that your retirement home, maybe you've owned it for a few years or whatever, you're crazy not to think about selling soon.
So Jeff,
you just never know what the future holds.
Yeah, I had 5 or 10 people ask me that question this year, and I said there was only one answer. This is a window of opportunity.
That's right.
For a baby boomer that now I've watched Orange County go from what, $130 a square foot to $180, $190.
Right.
Do I think it's going to go higher? It depends. It's cheaper than going down to Bergen County and the like, but this is a pretty good price that you're getting right now.
It's not worth messing around. It's good enough. The prices have come so high. Everybody who bought back in 03, 04, 05, 06 and paid way too much, well, they're probably back now again to that level, and they can get out and put some money in their pocket. If you need to do it, do it. Don't play the market. It's not worth doing.
I'm also finding some people that actually have the cash to buy are opting to do the financing because the mortgage rates are so low, and they're like, let's borrow the bank's money at this cheap rate, 2.5%.
It's hard to turn away these rates. It's hard to turn away these rates. They're so low. All right, guys, I am sorry, but I have to cut it off. Due to COVID, I have to pick up my kids every day at school. So I've got to run. This is a great panel. I just want to share the contact information of the panel real quick so everybody has that if they want it. Can't get to it. Here we go. So I think if you're sitting here watching this housing market update, you would agree. What a great panel this was. Everybody was very informative. We'll be back again next month. Thanks everybody for showing. Take care.